Tariq, welcome back. Good to have you with us. Why is it a concern if so many ESG funds seem to have so much of the same stuff, namely the largest parts of the QQQs or the top 100 NASDAQ stocks?
Well, there's a small problem and a big problem. The small problem is that it's usually dishonest, ethically dishonest, to sell something to people that, they think it's one thing based on what it says on the tin, and they're getting another. I mean, effectively, they're just paying more in fees to big asset managers for, really the same thing with green paint on top. And I think that there's a much bigger concern, which is that in the aggregate, it just acts as a placebo, right? Because we all buy these things thinking they're creating impact. Any impact created off these public markets funds just, moving around shares and giving responsible investors slightly more green basket, more green basket as a way to bump fees is just sort of achieves nothing and sort of delays us on actually acting on these issues.
So the fundamental concern, or one of them, if I'm understanding you correctly, is that the ESG version charges a higher fee for fundamentally a portfolio that is very, very similar to a triple Q portfolio that you could get at, let's say, a quarter of the fee.
That's pretty much it. I mean, with the ESG space, as with anything, there are areas where it makes sense. There's a kernel of truth for certain strategies and certain geographies, certain industries, and with a long-term focus that ESG matters. Unfortunately, the greatest impetus to use ESG for greenwashing exists at the opposite end. So it's not the private stuff where it matters. It's really all these public market funds that are commoditized, right? They track market indices for very, very thin fees. And so in a space like that, the impetus to paint the thing green to get a fee bump on a commoditized product is huge.
Do you buy the argument that I've seen written several times over the years that on average, socially responsible investment products slightly outperform broad market like an S&P 500 fund? Do you buy that?
I don't. I think that going forward, there's an argument to be made that more responsible companies may perform better, but the historical research is scant. It's, usually the most difficult thing is it's hard to measure ESG, so you're aggressing returns against sort of a moving object. But even the research that shows that ESG is good for returns is largely based on a paper that came out of HBS some years ago. There's another paper that came out recently by Andy King and Luca Bercicci that basically shows that you actually can't replicate any of that. It's just a statistical artifact because, ultimately, if any kind of analysis like that, any kind of regression, if you torture the numbers long enough, they'll tell you what you want. And everybody wants to hear that ESG is good for the returns and for the world.
It's notable, Tariq, that we just saw outflows for the first time in 5 years, about $300 billion by the end of June. So there is a bit of a turning of the tide here. I thought the Wall Street Journal interview over the weekend was great. They've launched Drill, and it kind of explains the philosophy there. And it was very interesting to see the phrase kind of putting profits before politics. And if this represents kind of a turning of the times where there is now a substantial enough pushback that you could see growth and asset flows going into funds like this newer one that are actually trying to push back against some ESG practices.
So I think fundamentally what they're doing is a waste of our time because it actually moves the debate where it doesn't need to be. So their argument is that Larry Fink is putting politics before purpose and they're going to come and rescue that. It's complete nonsense. Larry Fink, as they know well, is bound by the legal obligation of fiduciary duty to only focus first and foremost on profits. I can tell you with certainty as an ex-insider that that's exactly what's happening there and every other firm and has been for a long time. That's the problem. They're locked into only doing what's profitable and what's in society's interest, for example, investing more in green technology, doing things that reduce economic inequality. Those are not profitable. So the reality is that they're kind of having a debate that is all like words. On one hand, it's the free market self-corrects theory. Larry's, where you paint it green and make people feel better. I liken it to the Catholic Church practice of paying for indulgences. And on the right, you have basically a libertarian theory that pretends the marketing decoy is real so we can have a debate that doesn't include the obvious answer, which is regulating certain areas of the economy to protect the environment.